In this video, we will discuss measurements of risk versus rate of return. These kind of measurements are commonly applied to things like mutual funds or other types of investments to indicate whether or not a given investment is underperforming or outperforming an index fund. For example, we will look at the Vanguard European Stock Market Index Fund. The measurements we will examine are the Sharpe Ratio, which is the performance of an asset minus the risk-free rate over the standard deviation of the asset, the Treynor Ratio, which is the performance of an asset minus the risk-free rate over the beta of the asset, and Jensen's alpha, which is the rate of return of an asset minus the rate of return as required by the capital asset pricing model. Information for various investment portfolios of these types of measurements can be found at places like finance.yahoo.com. Again, here I use the example of a Vanguard investment fund, the Vanguard European Stock Index Fund. And it shows alphas. Jensen's alpha is commonly shortened as alpha, beta, the standard deviation, the Sharpe ratio, and the Treynor ratio. So for a Sharpe ratio, we want it to be as big as possible. Standard deviation is the risk measurement. We want that small. Rate of return, we want high. If we look at the Sharpe ratio here, we're given one for 3 years, for 5 years, and for 10 years. For 10 years, we get 0.4. For 5 years, we get a negative rate of return, quite bad. And for 3 years, we get 0.17. So over a 10-year period, this particular investment performed reasonably well. It did not over a 5-year or a 3-year. The Treynor ratio is a similar type of measurement, now using the rate of return of the portfolio minus the risk-free rate, which we want high, over the beta, the risk measurement, which we want low. And once again, under the Treynor ratio, the 10-year rate of return is reasonably good. The 5-year is negative, bad. The 3-year isn't too great. For the alpha, we want it positive, as large as possible, because we want a rate of return of our investment above that required by CAPM. In this case, all of the alphas are negative, so this investment underperforms what it should be required to, given the beta, the risk measurement of the investment. To look at this in more detail, we will use a sample investment, with RP being the sample rate of return of an asset of 12, R risk-free, the sample rate of return of the risk-free rate, which could be a T-bill, or a bank account of 3%, RM, the sample rate of return of the market, which could be the Wilshire 5000 or the S&P 500, and we assume it to be 11. Sigma P, the standard deviation of the asset, we assume to be 12. Sigma M, the standard deviation of the market, again something like the Wilshire 5000 or the S&P 500, we assume to be 14. Beta of the portfolio, which is the covariance of the portfolio with the rate of return of the market over the variance of the rate of return of the market, which we assume to be 1.2, and beta of the market is by definition 1. If we then want to calculate a Sharpe ratio for this example asset, we take RP minus R risk-free, which is G3 minus G4, R12 minus 3, divided by sigma P, which is G6 of 17, and get 0.53. We do the same thing for the market. The rate of return of the market is 11, the risk-free rate is 3, the standard deviation of the market is 14. So note the market has a higher Sharpe ratio than our investment, so we would be better off just investing in the market and not our investment. Also with the Treynor ratio, we take once again the rate of return of our investment minus the risk-free rate, now divided by the beta of our investment, and we get 0.075. We do the same thing with the market, and we take rate of return of the market 11 minus the risk-free rate of 3, G5 minus G4, divided by 1, since the beta of the market is by definition of 1, and we get 0.08. So again, the Treynor ratio is higher for the market than our investment. We would be better off in an index fund of the market than our investment. Once again, we will do this for Jensen's alpha. First, we calculate the required rate of return of our investment, which is going to be the risk-free rate of G4 plus the difference between the rate of return of the market of 11 and the risk-free rate of 11 minus 3, or 0.08 times G8 of 1.2 for the beta, and we get a required rate of return of 12.6% by cap M. We take the rate of return of our asset of 12 minus the 12.6, and we get a negative Jensen's alpha. So once again, we would be better off just investing in an index fund of the overall market than in this particular investment. By definition, the alpha of the market is 0. I thank you for watching this video.